Welcome to Unstoppable Real Estate Investing Wealth. My name is Billy Alvaro, aka the Unstoppable VA, former billion-dollar mortgage banker gone bankrupt turned professional real estate investor, where each week you'll learn the tools, strategies, systems, and secrets myself and other highly successful real estate investing entrepreneurs use to start, grow, and scale their businesses, creating massive profits, and how you can too. And we'll teach you how to put those profits to work so you no longer have to. Get ready to finally experience financial freedom and generational wealth. Now let's get started.
What is going on, everybody? Welcome back. Another episode, Unstoppable REI Wealth. I'm pretty freaking excited today because we're going to be talking to Mark Khuri, private equity entrepreneur. This guy is bringing cash to deals. And Mark, I'm really excited to have you on because this is something I wanted to get into. So I'm going to use this interview to actually, for self reasons, I'm going to pick your brain like crazy.
Sounds great.
How you doing, man?
I'm good. Yeah, doing well.
So Mark, tell me about the fund. You guys do all private equity?
Yeah, we've transitioned. I'll give a little backstory, Billy, just to kind of share with who we are or how we got here. But my family and I started raising capital from ourselves, just buying deals at the courthouse steps. This is through the Great Recession. We decided a few years later to go full time, open up our company, SMK Capital Management. That's my father and I's initials. And really what we were doing back then, Billy, is finding really great deals, buying them, rehabbing them, holding them, or selling them. That could be anything from 12 units to a single family home. A lot of the smaller single family, multifamily stuff.
Right.
And at the same time, I'd left corporate America. I had some money sitting idle in my 401k. I needed a place to invest it and was looking for diversification. So I started investing passively into like mobile home parks and self-storage, some larger apartment communities, just stuff that had done well through the recession. And fast forward to about 2017, we kind of stopped doing our own deals. We started really shifting all of our focus into private equity, raising capital from our investor network, partnering with operating partners that are specialists in one thing. And the goal for us and our investors is to just, again, be diversified, to invest in multiple asset classes, multiple regions, spread our people risk out, short-term, long-term, you name it. And so today we run a portfolio. We spread capital across thousands of apartments, thousands of storage facilities, mobile home parks, you name it. And that's really what we do today. We look at a ton of deals, Billy. We invest in about 5 or 6 a year. And so it's just a filtration process.
Yep.
Know what we're looking for. When we find it, we go.
Let's talk about, so is it money under management? How do you go about doing your deals? Like, do you say we have X amount of dollars on the management that we're deploying? Or so what do you have in your portfolio that you have out in the street right now?
Yeah, right now we've got about 45 million of equity under management that's actively invested across, I would say, probably about 40 plus partnerships, investments.
I love it.
We spread it across a lot of different deals across multiple asset classes.
Let's talk about how you go about attracting your investors into your private equity fund. What is that process like? What kind of returns are you telling them, or just take us through that process?
Yeah. So, I mean, we started out, Billy, by inviting our friends and family over to our house in 2009 or 10 and sharing with them a business plan through a PowerPoint presentation, right, in our basement, give them food and drink so they would stay and listen. And so very much trust, right? Who trusts you, who knows you, who likes you, work from there. A lot of those folks are still with us today. We're very proud of that. But then it just kind of grew organically. People talking, sharing what they're doing with us, kind of returns they're getting. Today, it's a little bit of a different strategy, very much referrals are number one source, but we also do educational content, attend seminars, speak at events, that kind of thing as well. And as far as returns go, we're very, very particular. We're looking for our investors to earn 3 to 7% cash flow beginning in year one from an investment. So we buy it and don't do anything. and the market turns, we're still going to earn, a nice cash flow in the beginning of the investment. We want that to be growing each year. So there's almost always some type of lever value add play that we're going to implement at the asset to grow net operating income, to grow cash flow. So while we're holding, we're trying to earn 7 to 12% cash on cash return. And then when we add in the sale of the asset, from start to finish, average annual ROI net to our investors, we're targeting 15 to 20% IRR, pretty similar depending on the length or duration of the investment.
What is your average length of the investments? Is it typical 5 to 7?
Yeah, today we're pretty much looking at nothing less than 5 years on purpose. It's more of a defensive strategy in case there's a recession. We don't want to be a seller at the wrong time. We tend to find assets that we can place debt with the same time frame as the business plan because they tend to go hand in hand. And so right now it's about 5+ years for most of our investments.
So tell me, when you're speaking to your potential investors that are out there, they're not investing in you as the operator, right? They're investing into your fund, but you're really not giving them a return. It's the investments vehicles that you're putting your money into. So what is that process like when you're educating your clients? Because generally, right, it's the operators that are going out trying to raise the capital to put into their own deals. You're really acting as the fund who's investing in multiple deals. So what is that? I don't want to call it a pitch, but what does the story look like when you're going out to investors and you're telling them this?
Yeah, I mean, there's a lot of ways to do real estate investing, right? So a lot of our investors, they have those contacts, they have those relationships, they have operating partners that they invest direct with, that they trust, know, and like. But they also, aren't in it full time searching day in and day out for the right people and the right deals. They may not have expertise from a finance and underwriting background to be able to analyze deals for risk. And they also may not have the minimums needed to be able to get into some deals. And there's a lot of advantages that we can bring through our structure to allow people to get access to deals, diversify. And again, the goal, reducing risk while maintaining really strong returns. That's kind of what we're trying to do every day. And so over the years, Billy, we've underwritten, vetted, analyzed over 120 operating partners across multiple asset classes. It's a long-term process. It takes many, many years for us to be able to know kind of, number one, who we should be investing with.
Sure.
We've got 3 buckets, Billy. It's yes, maybe, and no when it comes to people. And the maybe is the largest, the no is second, and the yes is the shortest list. I mean, it's 10 to 12 groups, and that's it. And so it's a bit of our process. We also create funds where we will combine multiple investments from multiple operators into one investment vehicle. The benefit of those funds are diversification, right? You're spreading your capital across a bunch of different deals, and you're spreading your risk then across people, which is different operators, and asset classes, and different types of income versus growth, and putting them all together. So you should in turn be able to get a nicer blended return and still have a very attractive net return.
When your company, when you're going in and you're getting the money from the investors, you're putting it into your pool, and then you're deploying it, how does your company earn its income? Talk about that.
Yeah, so we charge a acquisition fee of about 1% or so on equity raised, and we have an annual asset management fee of around the same on equity raised, about 1%. So from there, most of our investments, Bill, we have a hurdle where it's really performance based, and the way it works, which I'm sure you're familiar with, is a preferred return that our investors must earn each year before we, the management company, participate in the cash flow or the profits. That preferred return is usually between 7 and 9%. And let's say year one, we're at 5%, and the preferred return is an 8. That 3 that we didn't get carries over to year 2. So now in year 2, we owe you the 8 plus 3, so it's 11. And so for us, most of the time, we don't make a bunch of money until the property sells on the back end. And so I honestly, we wouldn't earn a lot of income, Billy, if we're not choosing the right deals, because we wouldn't see that profit that we're talking about after the split. So that's kind of how we structure most of our deals.
So it's similar, almost the same way as that operators who are going out raising capital direct from from investors. You're just acting as a pool and you're doing basically the same thing. How does that come into play when you're dealing with operators, when they have their own hurdles that they're given and their own fees that they charge? How does that come into play? Because you have your fees and your hurdles plus their fees and their hurdles and their returns. So what does that look? How does that all pan out?
Totally. So, we're really more of a fund of funds model. And in this model, the way that we ensure that our investors aren't getting too fee burdened, right? Because that's what you're talking about. It's just too many fees, too many splits, too many people cutting out the pie. We almost always negotiate more favorable terms for our group, Billy. So our operating partner will typically give us a higher preferred return and a higher split above the preferred return than an investor would otherwise get if they knew the operator, knew the deal, underwrite it, and went direct. So that way, when we look at the net return to our investors, it's almost the same, very close to what they would get if they went direct. And so we're providing a service, we're providing underwriting analysis, we're creating deals, especially in funds that you just wouldn't get anywhere else, to create more diversification. Again, the goal for us is always to lower risk without sacrificing on return.
I love it. Let's talk about your deal flow. How do you go about sourcing? I know it's obviously relationships with operators, right? So tell us what you look for in the areas that you're looking into invest. And then I guess equal as important, the operator that you're looking to invest in.
Got it. So we have a pretty small sandbox that we play in. We tend to do the same thing over and over because it works. And so with that, we look at 10 to 30 deals a month. And we invest, again, in like 5 or 6 a year. And so filtration process, Billy, that starts usually with people. If we don't know an operating partner or in a group and they're sharing a deal with us, 99.9% of the time, we're not going to invest in that deal. Doesn't matter how attractive it looks. It's simply just more of a people first process. And now if it's an operating partner that we've vetted, we've underwritten, we get to know them, we like them, of course, then we'll take a little bit more serious deep dive into the analysis of the deal and see if it meets our goals, right? Investment criteria. But most of our operating partners come to us from a few different ways. One, we've invested with them before, personally, my family, our company, all of the above. We've got a track record together. We've got a relationship through experience, not just underwriting, right? We actually have live dollars actively invested with them. And they'll come to us, hey, Mark, we got a live deal. It's under LOI. Take a look. Are you and your family, your company interested in participating? So a lot of times we'll get access to deals really early in the process where our operating partner may not even have an investment summary done, right? They'll just send us a little bit of information on what they have in their pipeline. A lot of times our investors will share operating partners with us too. Hey, Mark, I've been investing with these guys for the last 3 years. You should take a look. They've been doing really well, and they'll send out an introductory email and connect us. So that's usually how we're getting deals today, Billy. It's all people, it's all relationships, and we get access to a lot of off-market and private deals that way.
I love it. Tell me, in your business, Mark, what size do you have? Is it a small group that you guys own and operate? Do you have multiple people that are working for you? And what are the roles inside the business? And then I want to dive deep into your underwriting, your analysis from there.
Sure. So when we were an operating partner, Billy, doing a lot of our own deals, we had a little bit larger staff than we do today. And so that included property manager, back office, admin, you name it. Now, today we run a pretty tight team where we have a CPA, we have a bookkeeper, myself, another portfolio manager. My father is retired, but he's more of like an advisor these days. We talk just about every day. He knows what's going on, loves the business, but doesn't want to get into the weeds anymore, right? He's playing golf in Florida a lot of the days. So that's our team. But really what we're relying on is our operating partners. So most of our operating partners are, again, specialists in one thing. They have built out a team that isn't solely reliable on any 1 or 2 or 3 people. Usually they have an acquisitions team in-house. They have a property management team in-house. They might have a full admin office with accounting, bookkeeping, maybe even an attorney on staff. A lot of them have, like some of our apartment operators, Billy, have over $1 billion in assets under management. just large, well built out teams where if you and I were going to make an investment, you almost want to just partner with them rather than try and recreate what they've got, right? That's
Sure.
how we look at it. And we do that across each asset class: apartments, mobile homes, self-storage. We do some ATM investing as well, really trying to find the best of the best in each of those asset classes and then creating a partnership with them.
So your deal flow comes in. Who is doing the deal analysis, the underwriting on these properties?
So it always starts with their team. They have a underwriter or team of analysts. They have an acquisitions team. And we start to learn about how do they underwrite first, right? Because they'll send us out over a pro forma financial model that might be, 15 different tabs in Excel all linked, and it's pretty sophisticated. So you got to understand that part of the business is the analysis. And then I'll take a look at it. I have a finance background. I was a financial analyst for a number of years.
So that's your role. Your role is deal analyst. When the deal comes in, you're looking at the pro forma, you're checking out the spreadsheet, you're making sure the numbers work.
I do. Yeah. I enjoy that part of the business. I try and weed out all the fluff that you can build into an underwriting model. It's easy to change numbers, Billy. With just a couple strokes of the keyboard, you can take an IRR from a 12 to a 16.
Yeah.
We watch out for that. That's exactly what I'm looking for. And really just start analyzing the deal I'm like, really, what's the goal, right? The goal is, hey, do we think that we have a very high likelihood of meeting or beating the projected returns? The answer has to be yes, or we just won't invest. It's that simple.
Do you find it difficult from fund to fund, you not being a specialist in any one? I know you're going with operators that are specialists, but the burden really is falling on your shoulders, Mark, as the analyst, to really check and double check and triple check the numbers that are being brought to you by the operator. And the way every deal is underwritten, mobile home park, apartment building, strip shopping center, commercial, there's all different nuances. How you must have a diverse background to know how to underwrite, or how to, I guess, check the underwrite from the operators. Fair statement?
Yeah. It takes time to learn all that, of course, Billy, but there is a lot of overlap between asset classes and strategies. And so while you're right, let's take two different scenarios. You have a 60% occupied mobile home community that is producing very little cash flow in year one. And the business model is to acquire homes, bring them into the community, and sell or rent them out and grow NOI over 2-3 years and create occupancy growth and revenue growth. That's a much different strategy than buying an apartment community with 350 units that's 96% occupied, and we're going to come in, and put $9,000 of renovations into each apartment over the first 2-3 years when leases come up for renewal. But there is some comparative relative overlap in those strategies too, right? We're looking at NOI growth, how quickly, how fast, how much. Is it aggressive? Is it conservative? Is it realistic? And you're looking, of course, at return on cost. Are you spending way too much? Is it even worth it to do these kinds of renovations and upgrades? A lot of times we'll go back and we'll look at the operating partner like, hey, this is great. You want to bring in 60 new mobile homes into this community over the next 2 years. Show me why you think you can do this. And if they don't have experience doing that, that increases risk right off the bat, right? But if they can say, hey, we've done this 10 times within 150 miles of this property, and here's our track record on each property. This is how deep we tend to go. We want to look at their performance of their existing portfolio. We want to see if their expectations and assumptions that they're giving us have actually been proven before, or is it hypothetical, right? Because it's easy to come up with a bunch of plans, but can you actually do it? And that's a big part of it too, is just trying to understand how much is real and how much is hope.
It's insane. I was reading the information you sent over. I know you guys are hot with affordable housing. Why is that one of your favorite asset classes?
Gosh, yeah. So we've been investing in I use the term a bit loosely, in affordable housing for a number of years. We started in mobile home parks 10 years ago, 12 years ago now. We're in 2023. But we also love apartments as well. And why is because we think that there's a very long tailwind of demand that is in our favor. That's demand from residents, the user, the customer, the client, and also demand from investor groups. That's who we sell to, right? So we're looking at our exit. Is the pool of investor buyers growing for this asset class or shrinking, right? So you take the opposite spectrum of office. Well, we don't touch office. I think there's just way too much risk there. And I think the pool of buyers of office is shrinking. And so in 5 years, there'll be less people interested in that than there will be today, where the opposite is for affordable housing.
No doubt.
That's a big part of it for us, Billy. There's so much data and trends that we track and have been tracking for years. It's really a crisis in America. There's not enough affordable housing. That is a fact across every single state. And there is some sweet spots within the asset class that we like to invest in where we can increase affordable housing for the local community and still generate really attractive returns.
You have, I don't know if you mentioned earlier, I think you were starting it, we went down another road. Do you have specific geographic areas that you like to invest in, or you're diversified all over the place?
It's a little bit of both. And the reason why is because I tell you where we don't typically invest in, which is usually the Northeast.
Yeah, New York and New Jersey.
Yeah,
Anywhere where the tenant laws are in the favor of the tenants.
You know what I mean? Exactly. California, the coast tend to not produce cash flow. We love cash flow. And so we're trying to always source opportunities where there's cash flow day one. And so where does that leave us? It leaves us in the Midwest. It leaves us in the Sunshine States, the Sun Belt states. Again, you'll look at the data. Texas continues to be one of the fastest growing states in so many different data points across the country. So we love Texas. Not everything in Texas is great, but you tend to reduce a little bit of risk in that state because of the tailwinds of growth from companies moving there, net in migration, people moving there, job growth. You also look at, the number of births each year is just outstanding. Like the natural population growth is higher than people moving in. And so if you think about 5-10 years down the road, those people 15 years down the road will become residents at some of the communities that we own and operate. So
good stuff, man. Good, really good stuff. What's on the horizon for you guys? Like, where do you see yourself going over the next 5 and 10?
Yeah, I mean, we've pivoted it a few times in the last several years, Billy. So maybe I'll start by sharing, what have we done differently with all the different adjustments in the market and what's been happening in the economy. So today, what are we just clearing Q1 of 2023? We've continued to have, interest rates keep going up. They've been going up for a year steadily, but we think maybe we're near the end of that based on what the Fed's been sharing, based on inflation data, which has been going down relatively consistently. And so we position our investments typically today with long-term fixed rate debt on purpose. There's pros and cons to short rate, floating rate debt, and long-term fixed rate debt. But we try and become a bit more conservative. We don't want to be sellers at the wrong time. And then as far as asset classes, we've been, again, let's talk about affordable housing. We love tax exempt apartment communities. I don't know if you're familiar with them, but it's a public-private partnership that our operating partners create a partnership with a local housing authority or municipality. We keep, an apartment community, for example, we'll keep 50% of the units, Billy, affordable by definition. It's a formula based on local area median income, and the other 50 at market rate. And for keeping those 50 affordable, you get a typically 99-year property tax exemption.
That's insane.
It's an amazing sector. We love it. We've been focusing heavily on that for a little over a year now, and it continues to be one of our favorite asset classes. So what we're doing there is we're creating affordable housing because you're letting the rents be affordable to the local community, half of them at least. And in turn, you get very favorable debt. The agency lenders, Billy, have certain mandates that they have to loan a certain amount of money each year for affordable projects. And so these tend to fall in that bucket. We'll get 10-year fixed rate debt, 7 years of interest only, and a really attractive, LTV percentage. And so that's an asset class that we're going to continue to do until the margins maybe get too competitive. So maybe don't tell anybody about it.
So just out of curiosity, when you run your model through and you do your analysis, how big of a difference is it making for you to get 99 years worth of taxes abated versus paying taxes and getting market rate, like what does that analysis look like? Because it's almost like one half dozen of the other. Could be, at least. I don't know. I don't have the numbers, but in your analysis, how does that pan out?
Yeah, listen, if there isn't an economic benefit, you're not going to do it. It's a lot of work. And so it's not easy to do. So there has to be an upside. Otherwise, it wouldn't happen. And so typically we'll see that in our underwriting, we're going to project to lower the rents, revenue. I think on one of the latest deals we did, Billy, for example, we reduced revenue by $230,000 a year. But in turn, we got $1 million tax savings.
Over what time frame?
Annually. So it's for 99 years. The taxes are.
So that's $1 million a year. That's a no-brainer. You're getting 5-to-1 for the money. I mean, that's an insane return.
Exactly.
Do that all day long. Yeah.
Do that all day long. Yeah.
And are you seeing those in more of the larger cities, the metropolitan areas, or the tertiary areas?
The ones that we've done so far have been in Dallas. They've been in Houston and Corpus Christi.
Yeah.
Yep.
I love it. That's a great hook. Yeah, they do that out here in the 5 boroughs. They have certain things like that, certain programs and whatnot. I don't know about 99 years, but there's definitely programs where they have the tax abatement for 15 or 20 or 25 years.
Oh,
99 is insane.
Yeah. It's a very, very interesting program. We're all in on it. We'll see how long it lasts. Anticipate regulation will change at some point, Billy, and it'll become a little bit less favorable. But nonetheless, it is a really good structure and program to create affordable housing, which is extremely needed, obviously.
Listen, Mark, this has been it's been a great interview. I don't like going 45, 50 minutes. It's just too long.
Sure.
I think a half hour, 35 minutes is perfect.
I agree.
If people want to find out more about you and your business, how do they go about looking you guys up?
Yeah. Thanks, Billy. So our company is SMK Capital Management. Our website is smkcap.com. And then people can go there. They can learn a ton about us, and you can reach out. Email us at info@smkcap.com. That's usually the best way. Happy to share more about what we're doing.
Beautiful, brother. It's been a pleasure having you on. Good to meet you. And I'll see you again.
Thank you, Billy.